All right, guys, what's going on? Welcome back. I haven't recorded in a couple weeks. I think it's been like a week and a half or so. I just kind of been focused on my own trading, but this video is kind of just going to be a weekend review, and I'm just going to talk about kind of how I plan my weekend. So at the end of the week, usually Sunday evening, I'm sitting down reviewing the market, and I'm strategizing for the following week. So a big part of my trading is preparation. Before I head into any trading week or trading day, I pretty much already have an idea what I want to do. And you'll kind of learn with my trader's toolbox, right? With ICT concepts, there's a couple different things that you need to understand to have a clear trading model and a trading plan. So at the end of the week, the following week, I pretty much already know which days I'm going to be active, how I can, fit a market profile, something that you'll probably learn in the future, how I can fit a certain profile into the calendar week and understanding what I'm expecting out of the markets within a given week. So just with that in mind, I'm going to talk about this specific week, this past week. So last weekend, coming into this week, we have to check the economic calendar to understand what news drivers are going to drive volatility in the market, right? Where ICT mentions that this calendar is like your treasure map. And if you study this long enough, the same repeatable patterns happen in the marketplace day in, day out, week in, week out. All right. So coming into this week, we had a major news announcement on Tuesday, which is inflation data, right? CPI, core CPI. So this has been pretty much driving markets recently. Inflation's been a hot topic. So given this in mind, ahead of this week, you can plan your trading week out ahead of time. And based on last week's trading, we have some type of expectation. Now, it's been mentioned a couple times, numerous times, where the high of the week is either formed on Monday, Tuesday, or Wednesday. It's 70-75% of the time that's going to be the case. So going into this week, right, a lot of institutional money is going to be waiting until this release comes out, right? A lot of big traders are not positioned ahead of this news release. So keeping that in mind, right, we're expecting something to happen on Tuesday after this news release comes out. And how can we manage our expectations around the market? And what kind of market profile are we going to expect? Well, I already have in mind that this is probably the likely driver that is going to create the high or the low in the dollar, which would opposingly create the high or low in risk assets. Right? So if I'm expecting a Tuesday high of the week or Tuesday low of the week, right? If I'm bullish on the dollar, Tuesday low of the week would correlate to Tuesday high of the week in risk assets. So you would see Tuesday high of the weeks in euro, pound, S&P, gold, any risk asset. So let's hop over to, we can take a look at the rest of the calendar, right? Wednesday, we had core retail sales. This is not as important. And then Thursday, we have core PPI. So with a Tuesday high or low of the week, typically, if there's no news on Friday, we're going to meet the opposing end of the range by Thursday. So Thursdays are typically reversal profiles. Okay? So let's hop over into the dollar index, right? So in this trader's toolbox, there's technical tools. So we have the PD array matrix. And there are just certain ICT concepts that we have to pay attention to. Right? We have institutional reference points that we have to reference. We have old highs, old lows. I'm just going to put this in order, right? So if we have bearish PD arrays and we have bullish PD arrays. we have old highs, rejection blocks, mitigation blocks, breakers, fair value gaps. This, so rejection blocks, and then we have order blocks. Okay, so that makes our bullish PD, or sorry, our bearish PD. And then on the other end, right, I'm gonna draw a line here. Below the market, we would have fair value gaps. Pretty much just flipping this, right? Breakers, mitigation blocks, order blocks, rejection blocks, and old lows. Now, this is current market price, okay? So when we're trading, we have to be mindful of where we are in the PD array matrix. And if there are PD arrays below the market, right? If we're expecting dollar to be bullish and expecting a Tuesday low of the week, we are expecting one of these PD arrays to be touched on Tuesday before a rally higher. Okay, so on the weekly time frame, we have purged this low. This is an institutional reference point. We have this old fair value gap. And then if we zoom in, we have another fair value gap inside of here. So this is our weekly bullish PD raise, right? The old low is at the extreme of bullish PD ray. And then we have on this weekly close, right? We're going to have PD rays above the marketplace. So we're going to have to measure out, right? So each one of these PD rays has a specific range attributed to it. Well, some of them do. Right, so fair value gaps, rejection blocks. If we measure a fair value gap or a rejection block, this is a rejection block. This wick is the rejection. 50% of that range is a PD ray. All right, so and then if we measure this PD ray back here, right? So each one of these is going to have a midpoint. Order blocks have midpoints. Right? And if we measure this order block back here, we get price on this one, 102.330. Now, when you're measuring these out, you want to get the exact prices. You don't want to just randomly guess what these prices are, because these are static prices. This is consequent encroachment. Any 50% range of a PD ray is consequent encroachment. Right, so that's quickly how we define our bullish PD rays if we're bullish on the dollar. Now, what am I looking at next week? Well, we're above this fair value gap, so that to me is bullish. If price is going to expand higher, it should not, on a closing basis, come back below this range. So above the marketplace, we have consequent encroachment of last week's wick, one that just closed on Friday. 104.259. We have weekly consequent encroachment. And then 50% of this wick. Then you have this. So we have last week's high also. That's going to be an important level. And 50% of this wick. So on the upside, these are all important prices. So that 50% of this wick almost lines up with last week's high. So you don't really have to pay attention to it as much on a lower time frame. It's going to be about the same price. All right, then we have this week's high back here. Just group all these real quick. So if I drop down into a daily, I can quickly hide this. All these drawings. All right. Now let's drop into a daily. And I'm going to throw on my indicator. So, referring to the calendar, right? If we're bullish on the dollar based on our weekly levels, right? These are our weekly levels shown on a daily time frame. If we're expecting Tuesday to provide volatility and possibly create either the high or the low of the week, we're looking for some type of bullish PD array to go long. Right, so this is Tuesday. This is the CPI candle. This candle right here is the CPI. Right, so what is the PD array that we were referencing on Tuesday? We're just going and taking the low prior to it running higher. Save that. Now let's drop in and specifically look at Tuesday. Right, so this is the CPI release at 8:30 a.m. You can see how if you were long or short prior to the news release, you possibly would have been stopped out. So institutional money is waiting for this number to digest in the market. And once that number is released, we are expecting some type of reaction. So what we're looking for is just a sweep on liquidity or a fair value gap or order block. One of those reference points provide us information where we can position ourselves in a high probability setup. Now, once we see this low swept, who's trapped in the market? Sellers are now trapped in their position because they are inducing them into the marketplace before it's turning around. All right, so once that releases out, we can position ourselves long in the dollar, and that would be short in the risk markets. So we can flip over to the S&P. Now this was Tuesday, right? Where was the high of the week? Bearish. All right. There's opportunities in here to go short, right? So we have on an intraday basis, there's a PD array back here as a rejection block. Right? This wick from Tuesday, February 7th. Right? And inside of that range, we have the 50% range as well. So 4181.50. You make it a different color, do whatever you want. Your annotation is going to be specific to you. Now, if we're to drop into a lower time frame, right? This is Tuesday, a 5-minute time frame. This is the candle that occurs on inflation data. Once the release is out, we can wait for a little bit of time to get short on this marketplace. Right? So inside of a higher time frame analysis, right, on a daily or a weekly, let's flip over to the weekly and see what reference points we can reference. Right? So that rejection block is a daily PD array. Okay, so when you get good at this, you really only need to understand what is the most recent price point that is being referenced. right? And if you were to get short on Tuesday with your stop above the CPI print high, that's a high probability setup to hold, even if it goes against you, right? Your stop management has to be in a position where you're not going to get stopped out, right? Above a daily high, right? Let's take, for example, and then let's say if you were to hold this all the way till Friday, this is what your intraday trade would look like. Let's say you got in just a bit after the news. Right? This is 10:30. This is around lunchtime. If your stop is placed at a specific level, you can even scalp short and take partials, or you can be, let's say if you were taking a trade on an hourly chart, this takes some time to pan out, right? But we're expecting a certain market profile to be in place based on this calendar, right? If Tuesday is going to provide the high, let's say if you don't trade on Tuesday at all, the narrative is still, this was a high impact news release and core retail sales should not have that much of an impact. So this is part of your preparation. You need to come to the calendar first and foremost, right? And understand what is going to drive the market. If you're just going to the chart straight away and don't have any idea of some of these concepts, right? So each one of those items in my toolbox has an equity curve, right? And you're not going to learn all of it in one go. Learning all of these concepts takes time. Okay? One of these concepts has its own equity curve. You're going to have learning periods of growth when you're studying each one of these. So you can't just, on a surface levels, yes, it's easy to just look at it and be like, oh, that's a projection block, that's an order block, that's an old high, that's an old low, oh, that's a breaker. You have to visually see it pan out over and over and over and over again. And that's mastery, right? Yes, you can be profitable just using one of these. But if you were in ICT space today, he can build a narrative around what's currently being traded and not have to wait for one of these, right? You're just using what's most prevalent and current in the marketplace right now. But each one of these is going to have an equity curve. There's no way that you're going to be able to learn and master each one of these overnight, right? When you're learning fair value gaps, you're going to trade fair value gaps. You're going to learn something new about them, right? You're going to lose on some of them. This is your equity curve of learning the tool. Okay, and I've got a ton of tools in my toolbox that I can reference, but it takes time and experience to get to that point. What do I do with the Fibonacci retracement, right? I'm measuring premium and discount. You have to use the tool, right? Just compare this to basketball. One of these is a jump shot. One of these is your Euro step. One of these is your three-pointer. One of these is dribbling. One of these is passing. If you're in my Twitter comments saying I can master this in a year, you're out of your mind. We're talking about a professional environment, right? You're battling against the brightest minds in the world. And when it comes to the markets, these individuals are ruthless. These institutions are ruthless. It's akin to you going on a football field and saying, I'm gonna, join the New York Giants tomorrow. You're gonna get murdered. They're going to come in, take your money, take your lunch money, and then you're done. So you can't expect to learn all of this overnight. And if you're in my comments saying you can learn this in 2-3 months, just unfollow me now. Yes, you can learn one of them and be very good at one of them. Right? But if I can only shoot free throws, they're not going to put me in the starting lineup. You need to build a skill set behind trading. Okay, so if we jump back into the S&P, right? Let's say if you were to go short on Tuesday, that's a great trade, right? It's based on the calendar and it's based on a market profile. So, what was I looking for this past Friday? When the market opened at 9, well, the futures market is constantly trading. Right? When the market opens at 9:30, equities open, the market's gapped down already. Right? This is Friday's price action. So when the market's gapped down, who's chasing it? Right? Retail wants to chase this move lower on a Friday. Now, one of these market profiles is a TGIF setup, or you're just expecting the market to trade back inside of a weekly range. Right? So if Tuesday is going to create the high of the week, then either Thursday or Friday should create the opposite end of the range. Okay, so if we go to the dollar index, what is going to create the opposite end of the weekly range? So this is an order block. It's a bullish candle before a bearish impulse swing. So we're going to measure out 50% of that range from open to close. Don't look at the wicks. Right, so what is the price on here? It's 104.610. So this is consequent encroachment, or 50% of this daily order block. So if we drop into Friday, right, this is our New York open, 7 a.m., then equities open at 9:30. So if we're expecting a TGIF setup and the S&P gaps down, well, the AM session is going to be very slow and choppy. And I took a trade in the morning and took a loss on the AM session. But the PM session provided a great setup for us to go long. So when we're segmenting our intraday price action, we're keying off of higher time frame levels. What is this level down here? This is last Friday's low. This is February 10th, 7 a.m. We can make this bold. And we'll drop down and some text. So if the market gaps down during the AM session, it's typically choppy. Right? So with the trader's toolbox, we're going to go in and during the PM session, if we expect a rally back into the range, the range has been created. There are days. We have Monday, Tuesday, Wednesday, Thursday, Friday. Okay. Tuesday, high of the week. Wednesday, just returned to premium. Thursday, sold off. If we're expecting a TGIF setup, trading back into the range, we're looking for a bullish PD array, right? And the extreme is going to be an old low. Okay, and this is the low that is visually the easiest to spot. And I'll post my my actual trade in the Discord after this session is over. So let's mark out 1:30 on our time axis. Right? So this 1:30 marker starts the PM session. Right? And so we're gonna dissect the hell out of this 5-minute chart. So what do we see in here? We have a fair value gap. Well, let's just start back here. This is a rejection block. 50% of that range is our 5-minute rejection block. Now keep in mind, this thick black line is our higher time frame PD array. We're just using the 5-minute time frame to pinpoint an entry. But it's an hourly idea. So if I'm using the hour, the 15-minute, and the 5-minute, right, I'm using either the middle or the highest time frame to manage my trade, and the lowest time frame is only used to execute. Okay, now this is a gem that a lot of people don't get. When you're trading and well, let's say if you're preparing to trade and your whole preparation is behind a specific model, right? Use 3 time frames, and your lowest time frame is only your execution. So where I lost a lot of money was I would see a setup on the hourly, take it on the hourly, and then I would start dropping down into lower time frames for whatever reason, and I would get lost in the price action and try and manage it on the lower time frame. Do yourself a favor and take notes when I'm talking about this, because it'll save you a lot of time and frustration. If you're going to use 3 time frames, doesn't matter if it's the daily, 4-hour, 1 hour, right? Your 1 hour is your execution, but then you're managing it on the 4-hour or the daily, right? If I'm using the 1 hour, the 15-minute, or the 5-minute, I'm placing my trades on the 5-minute, but I'm managing it on the 15-minute or the hour. Okay, so that's our bullish PD array. Then we have fair value gap in here. And then we have another fair value gap in here that is broken. This is an order block, this down close candle. So when this fair value gap is violated, right, and then this high is violated and this high is violated, we have a break in market structure, or a market structure shift. It's a market structure shift. It's going to return to a bullish order block as a retracement to go higher. Right? So what is it doing on this retracement? Just keep in mind, on a 5-minute time frame, you could do the same thing on a daily. Once we reach a premium, it's going to retrace to a discount before it's allowed to go higher. We can use a Fibonacci here and measure out this range. Right? It's only coming back to a discount level, filling in this candle, and then it's trading higher. Now this becomes a breakaway gap. So it's most likely that this is going to be left open. You don't want price to come back here and refill in here. Now, when the candle's printing live, right, it's easy to go back and say in hindsight, oh yeah, this is what it's going to do. I can see this visually now in hindsight. But when the candles are printing, this is part of experience, right? If you're going to take jump shots or free throws, you have to get in the gym and practice. And a lot of times, right, game time situation, you're not going to know what's going to happen next. It's about getting experience on the floor, on the court, in real-time situations with an uncertain future. Right, when the candles are printing, I just know we're in PM session. We've already taken last Friday's low. So I'm looking for a trade higher as a TGIF setup. Right, so I'm in here on a 5-minute time frame based off of the hourly purge of that old low. And I'm analyzing real time as these 5-minute candles are printing. Where can I enter at a discount and what am I targeting? Right? So you can use Fibonacci extensions as targets. and you can just exit at old highs. This is the morning session high. This is the AM session high. So whoever was short has their buy stop resting above the high, right? And that's what we're targeting. But I was targeting the new day opening gap. So on index futures markets, right, there's a layover between 5 p.m. and 6 p.m. Eastern time. Creating a gap in price between the close and the open. So that was my draw on liquidity. And all I'm doing is trying to go long during the PM during the PM session. Frame a trade with the expectation that this is my draw on price. And oftentimes I'll have a magnet up here expecting that price is going to gravitate towards that level. Okay, so that's how I framed a PM session setup. And now, when you're segmenting your time, you're only expecting a certain move within a couple hours, right? 1:30 to 4 o'clock is your PM session. You don't need to trade into 5. This is all you need. This one specific window. Or the AM session. There's one specific window in the AM session. But we're using an hourly chart or a daily chart to find setup, and we're using the lower time frame to execute. Okay, so when I'm in preparation of my trading week, I'm looking for higher time frame PD arrays to be hit prior to me going into a 5-minute chart and finding a setup. Right? A lot of new traders have it backwards, where they're hopping straight into the lower time frame and saying the lower time frame is where reversals occur. No, right? Big funds are trading off of daily charts. If I were to hide all this lipstick, right, I can see this daily low very clearly. I just want to know what the next 24 hours is going to look like. And when I'm trading intraday PM session, I only give a shit about the next 2 to 3 hours. If I can't find a setup, then why am I trading? Or if I take a loss, then just come back tomorrow. You're gonna find something like this every single day. But again, the trader toolbox is, there's a lot that goes into a toolbox. You can't sharpen your tools if you got a dull ass hammer. You know, if you got a dull ass, I don't know. You get the point, right? So when you're trying to sharpen your skills, maybe it's just a fair value gap. You gotta pour all your time into understanding a fair value gap. Pour all your time into understanding Fibonacci retracements. Pour all your time into learning rejection blocks. And pour all your time into learning a specific tool and then applying all of them, right? When you're first learning, you can just plot fair value gaps. But to get a deeper narrative, you have to understand all of it. Okay? And that's real mastery. So let's just jump back out to weekly time frame. I'm not going to spend too much more time recording here. And what are we expecting for the dollar? Okay. So let's go over to the calendar. I don't have any of the foreign currencies shown here for next week, just to keep things easy. All right, so we have Tuesday flash PMI services, then Wednesday FOMC meeting minutes. I'm not 100% sure which one's going to create the high or the low of the week. It could be the flash services PMI or the FOMC meeting minutes. But if I had to take a guess, I would put my money on FOMC meeting minutes on Wednesday. So, given this calendar, right, we're going to have an AM session set up possibly in the next market at 9:45. All right, so once this news comes out, we might be able to find a position before this release comes out. So what are we expecting? Well, if the dollar can stay above this fair value gap, right? This is reclaimed fair value gap. I'm expecting to find some level or bullish PD array to support price and push it higher on Tuesday, right? And then we're going to target last week's high. Well, we have this 50% of this wick, then the high, and then this high back here. Okay. What is our invalidation level? Well, there's also a daily fair value gap in here. This was our Tuesday low of the week inside of the weekly fair value gap. Right, so if we lose the low from last week, let's say, well, I wouldn't say lose the low because they could come down here, retest the fair value gap, and trade higher. On a closing basis, if it gets down below this fair value gap and this fair value gap, then I'm no longer bullish on the dollar, and I'm going to have to reassess. But what I'm expecting for next week, right, this is my preparation is Tuesday low of the week in the dollar, or Wednesday low of the week in the dollar. So what do we have on the daily chart? Right, so now this consolidation in here, I'm just going to try and hide all of this. Hide the weekly. We have this claimed fair value gap. This bullish order block. And then we have the wick of this on Thursday's candle. So I think anything in here would be a good area to go long on Tuesday. Right, and then all we need to do is get above the consequent encroachment of this daily order block. So then on a daily, we'll have, right, this wick. We have another rejection block in here. So anything long in here, we're going to try and target above these highs, right? We can take a partial at 50% of this wick, above this high, above this high. So if we're going to plan a trade, let's just say ahead of time, I'm going to plan a long position. We're going to have a final target possibly up here. Right? You can plan a 6 to 1 risk reward. Sorry, 1 to 6 risk reward. But when I'm planning this trade as my trade for the week, right, I have specific levels in here that are going to be my targets. So you have to pay yourself as the market's going in your direction. And you might have the open on Friday's candle. That could be your first target. Your second target could be above the high. And then your final, you can have multiple targets in here. That's my point. You don't have to just be all in, all out on a trade. Right? When the market offers you money, take something off. Because partials never fail to pay. That was the hardest thing I had to learn, was taking partials not only reduced the stress in the trade, but it allowed me to more effectively manage my position. Right? I'm no longer making emotional decisions based on a huge position fluctuating back and forth. Because when the market's trading around, we don't know if it's going to reach our final targets. And many times it doesn't. We just have a specific area in mind, right? My draw on the S&P was the new day opening gap. It didn't get there. Right? All I need is a magnet on price. I don't need to demand that it's going to get to my final target. Right? You can take a partial in here, take a partial in here, and then leave the balance to run to your final target. Right, so as long as the market's moving in your direction, take something off. Because when the market starts trading against you, you're going to wish you did. All right, so that is my bias on the dollar. I'm bullish on the dollar until proven otherwise. Now let's look at the S&P. So on a weekly time frame, this closed bearish, and we are above these highs. So on our bearish PD array matrix, we're above these highs. So I'm expecting, just measure our dealing range. We're in a premium right now. If we're going to measure premium discount on a weekly time frame, we are in a premium. So right now, as a position trader or somebody that is an institution that is trading these higher time frames, right? The larger banks and institutions and traders are trading on the higher time frames because they can't get filled on their orders using a tight stop, right? Imagine if you were trying to place an order for, I don't know, $10 million, right? You can't use a 5-point stop loss. You're not even gonna get filled at the same price probably. So these bigger funds and institutions are trading on a higher time frame. So we just want to ride the coattails of whatever this current structure is. We want to ride the coattails of smart money. So if we're in a premium, we're looking to sell short. So our first, and where does the equilibrium point line up? We have a bullish order block. If institutions are buying inside of down candles before the rally higher. So this is algorithmic, right? If we're drawing our anchor point from this low to this high, 50% range actually lines up almost perfectly with the 50% range of this bullish order block. Right? We're 75 cents off. So this is 4,004. This is 4,000.75. And I use the magnet tool over here so it snaps to open, high, low, and close prices of each candle. And so this is going to be a major point of interest. So when it gets there, we don't just say, I'm going to buy it. We have to wait for market structure on a lower time frame, right? Just like I did with my ES trade on a lower time frame. Right? I'm not going long. If you go long and you take a loss, right now we have to wait for additional information. So just for your, education, we did take a long in here and got stopped out. Okay, so when we saw this had already swept Friday's low, this move here. So we went long prior to the index, the equities open. We got stopped out. So we have to wait for more information. The market structure shifts at some point, right? This is a market structure shift, or you can wait for this market structure shift on a lower time frame. So we need signatures and price to tell us, okay, now the market is turning. Right? You're not just going in there and buying every level as soon as it gets touched. You're gonna lose money now. So when these higher time frame levels get hit, then we have to wait for more information. Right? Then we're stalking a setup on the lower time frame. But if we're gonna continue being bullish on the dollar, then this level should be broken. And when it is broken, it can act as an area of resistance if we retest and then trade lower. So if we do trade lower, you have to keep in mind that this rejection, right, 50% of this wick is 3945.25. Now you see I'm using the fib tool to give me the actual price that I'm trying to, that I'm talking about. I'm not just eyeballing it, right? I'm actually going in here typing in the prices. Right? Because when those levels are hit, right, they're precise. They're not it's not random. So that would be another area where we would possibly have to wait for more information. Alright, so until this shows us that it's bullish, what's my invalidation? Probably above this rejection. If we can get back above consequent encroachment, which is the 50% range of that wick, which is 41.25, 41.78. So until we get above this level, I'm still bearish. Right, if we get a closure above this, it's likely going to trade higher into this volume imbalance back here. All right, so what are we seeing on the daily time frame? So this was our setup on Friday, right? We swept the low, and it just traded back into the range. All right, this is our Tuesday high of the week, like we spoke about. So what do we have on the upside? We have this bullish order block in here. We have the wick of this bullish order block. Inside the 50% range of that wick, we have another level. So let's say Monday does trade up here. Right? Tuesday, if we're at a premium on the daily, I'm only hunting shorts. I'm not saying, oh, the market's up on Monday, let's buy it. No, that's emotional trading. You have to understand price and what it's doing, right? Use the calendar and plan your trading week ahead of time. Right? It could trade up there it could trade up there Tuesday and Wednesday. Right? Tuesday could just be choppy up here. And Wednesday, then we get the high of the week and then send it low. So you have to be patient. We're not just going in Monday and fucking trading our beliefs about where the market's gonna go. You gotta have a plan in place and you have to know what you're looking for. That's the biggest thing. And you can make it very easy on yourself. New traders and traders that are just getting in the market, they love to make shit hard on themselves because they're doing things outside of a plan. Right? Look at the calendar, plan your week ahead of time. If I was an NBA player, I'm planning when I'm going to the gym. I know on Tuesday, I'm going to work on free throws. On Wednesday, I'm going to work on jump shots. On Thursday, I'm going to work on my dribbling. Right? Have an idea in mind of what you're going to work on. Because when you're first getting started, you got no fucking idea what to work on and you just want to trade. Well, you're not learning anything. I wasted so many years trying to do that. I'm going to sit at the chart and trade and not have any idea. I'm just going to go in there and try and make money. But guess what? I didn't make any fucking money. I did that for years. So don't waste your time thinking like, the market's there, I'm going to go in there and just figure it out. That's an easy way to fail. Right? When I stumbled on ICT, there was so much shit I had to learn. I tried to learn it all at once, and that was definitely not effective either. Right? But what I did do was I spent a lot of time going back through my charts and just drawing objects on a chart and studying them. Right? If you're only gonna focus on old highs and old lows, just go in there and do that, and don't get distracted. If you're gonna go in there and just study fair value gaps, just go in there and do that, and don't get distracted. Right? But you can't learn all this narrative. You can't learn it all if you're just going in there, taking 2 free throws, 3 jump shots, 2 3-pointers. That's not mastery, right? Trying to be a jack of all trades and a master of none. Right, so just focus on a couple things every week and you'll get there. It just takes time. Right, so we have this daily order block also, so 50% of this range, which kind of lines up with these old lows back in here. If I were to draw this out, 5 5 25. Right, it almost lines up perfectly with the low on Friday. Does it get any better than that? How close can you come? What is the low on Friday? 4055.50. came within 25 cents of the 50% range of this bullish order block. On a smaller time frame, right? This level right here, this lower one, is our 50% of the bullish order block. Right, so spend more time on the higher time frames, and you'll see on the lower time frame what it's doing, right? But you need to have an understanding of what it's doing on the higher time frame, because this is where all the money is. It's on the higher time frames. Don't go into the 5 minute or the 1 hour and just start trading away. You gotta understand what the daily's doing. And so we have that level. That's my premium level that I'm looking at. We also have this broken claim fair value gap inside. These are overlapped. Anything up here, we're looking to sell. So we can use a Fibonacci tool and measure from high to low here. And that's resting at equilibrium, but this order block and 50% is at a premium. We could trade all the way back up to the open. That's very possible. We could even trade into 50% of this bearish order block. I don't care where it's trading. I care about the time aspect. Right? ICT mentioned this, and this is a gem. He could trade and make millions of dollars with no chart. He just needs a clock and price. You can look at the ticker on CNBC, look at the open, high, low, and close, and trade based off of time. Right? That is a massive gem that I picked up recently, where time is driving everything. When time rolls around, what price are we at? Right? Let's say if FOMC comes out and we're down here. Well, maybe I'm looking for a bullish PD ray to go long. Right? To trade back up into a premium. Not really worried about what my opinion is of the market. I could give two shits. I'm trying to make money on the long side and the short side. And that revolves around what is time doing, right? What event is going to drive the market, and where is price at, right? Because if you want to get short on the index market and you don't realize that it's trading below a previous week's low, well, you're trying to force your opinion on a market that doesn't give a shit about your opinion. Right? It's trading to a discount already. You don't want to go short in here. Right, so then we have our daily levels marked out. Right, so this is our hourly chart. We're going to have hourly levels in here that we are possibly going to look at. We can make these lines hashed. Try not to have this many lines on my chart because I know what I'm looking for now. When you're first getting started, you do want to, at least if you're just learning, you know, if you're learning a free throw, you don't want to have everything on your chart. You just want to have the fair value gaps. Right? If you're just trading the old highs and the old lows, you don't want to have everything on your chart. You just want to have old highs and old lows. But when you're trading one PD array, right, you have to wait longer and be patient because you're not just in there trading everything. If you want to lose money, that's the easy way to do it. Let's say if I'm gonna only take a free throw. Let's say if I'm a specialist and I only can shoot a 3-point shot, right? And somebody dishes me the ball and I'm under the hoop and I have no fucking free throw. Are you gonna take the shot? Because if you are, you're gonna end up fucking unemployed and not on an NBA roster. Right? They hired you for a reason, and my only skill set is one specific thing. Right, so when you're learning these concepts, you want to stick with them until you can prove that you're consistent with that. Right? I'm at the point now where I can use multiple things and find a setup. But when you're first getting started, you don't want to do that. Just focus on a fair value gap, or focus on an order block, or focus on a Fibonacci retracement. So inside of the hourly, I'm expecting some of this range to be filled right before trade lower. So I hope this was helpful. I mean, you know, my trader toolbox is extensive. It's taken me a long time to sharpen the tools in my toolbox. It doesn't come to you overnight. It takes years and years of grinding to learn all this. But you can start small, and you can be profitable with just a couple of these. You can be. Right? They hire ball players that can only shoot 3-pointers. You can be a specialist in one, and eventually master them all and become an all-around player. But you got to focus on specific things first. And once we get out of there, once you learn all these technicals, right? This is all technical. The technical toolbox has nothing to do with risk management, trade management, weekly profiles, economic data. Right? This is all technical. Don't tell me you can learn all this shit in 2 or 3 months. If I was teaching the class and I was a professor, I'd kick you out. Right? In a professional career, they're not hiring undergrads for higher level positions. I didn't get hired in a higher level position. I had to work my way up. I had to build a skill set. But if you got no skill set, they're not going to hire you. You're going to tell them, oh, I got 2 or 3 months of education. You're hired. Get the fuck out of here. I got a lot of, I got a lot of comments on a Twitter post saying I can master all this shit real quick. And your expectation is just out of line, right? But you can take it slow. Don't get ahead of yourself. Learn how to trade these few concepts. This is all technical. And then focus on something else. Right? If your psychology's lacking, you got to focus on that too. Right? And focus on trade and risk management. When I'm in a 5-minute chart and I'm trading, I'll have to post my executions. Right? When the market's going your direction, take something off and move your stop loss. Like, when you're thinking about your equity curve, and this is part of trade management and risk management, when you're thinking about your equity curve, who cares if you get stopped out at break even 50 times in a row? I don't care if I'm aggressively managing my stop. I'm protecting my capital. Now, let's say if you don't manage your stop and you're taking large risks. Well, now what does your equity curve look like? You don't, like, this is jagged, and you're not going to get any growth out of that. Right? You need to be consistent with it. And the best way to be consistent is manage your stops aggressively, take partials when the market pays you. Because over time, you're going to see, you will visually see for yourself that your equity curve looks nice and smooth. Even if it's slow and gradual and tedious to do this, at least you're not fucking risking it all, taking huge hits, moving your stop losses. Alright, one thing that it's really a discipline thing, and it took me a long time to learn, was get rid of your ego when you're trying to take a trade. If you frame your trade and so you have an entry, a stop loss, and a target, don't do this. Don't open yourself up to more risk. I did that for so long because I didn't want to take a loss. You're going to have losing trades. That's just part of the game. It's business, right? My stop is here. The only thing I'm going to do is try and find an area to take a partial and reduce my risk. take a partial, reduce my risk. And if it comes back and takes me out, at least my equity curve is smooth. Right? If you look at your unrealized P&L curve and you're not taking any partials, well, it's going to look like this. Because what if this market comes back and stops you out? At a full loss, right? Your equity curve is actually going to be down here. That's your unrealized equity. Because you didn't take anything when the market moved in your direction. So your realized equity curve looks like this. Instead of smoothing it out and taking a partial, right? Pay yourself something. You don't have to force it and say, oh, I'm only going to take a partial at 3-1 or 5-1, because you're not going to get that every day. You might just get 1-1. But who cares? There's an opportunity tomorrow. That's the point I'm trying to make, is protect your capital. And when the market's going in your direction, take partials off quickly. Intraday, you got to take them off quickly. And that's the thing I had to learn when I shifted to intraday trading. And it depends on what time frame you're managing it on, right? If you're going to use the hourly as the lowest time frame, right, you got to manage it on the 4-hour and the daily. So if I take it on the daily, let's say if I went long right now, my target was there. Let's just say, assume I went long. I'm not going to drop down into an hourly and start managing my position. All right, I use the hour to enter my position, but I'm using the 4-hour or the daily to manage it. So when the market could take a whole week for it to even trade up into a premium, right? Each one of these candles is 4 hours. That's a long time, and it gives you a long time to make decisions, right? If you're sitting in front of the screen, you got to make a decision every 5 minutes if you're using a 5-minute chart. And at times it feels like an eternity when you're actually in the market. It feels like an eternity. But you got to be nimble and take the partials as the market's going up in your favor or down in your favor. Right? Because if it starts coming back on you, you're going to regret that you didn't take anything off up here. Right? Just say, for example, I partialed out here and you didn't take a partial, now it's down here. What is your emotion? You know, how do you gauge your emotion when that happens? Because I know how I feel when that happens. I feel pissed off. I'm like, shit, I should have taken something off. I knew it was above this high. Just don't even think about it. When it's going up, just take something off. Because then you don't have to think about it when it's coming against you. Right? When it's going in your favor, it's easy to think about it and just say, I'm going to pay myself now. When it's coming back on you, you're like a deer in headlights, and you're like, I don't know what the fuck to do now. Like, do I move my stop? Do I take a partial down here? Do I wait for it to expand higher? Like, do I move my stop lower because I think the target's going to run higher? All right, this is a whole skill set that your decision making can be everything. Like, it's one thing to understand the technicals, but it's another decision making process-wise. Right? You got to make good decisions based on your analysis of yourself and the technicals. So that trade management is another skill set that is completely outside of this technical thing. Alright, so I hope you guys found this insightful. Let me know if you have any questions.